All right. So why don't we go ahead and get started, and then as the webinar goes along, we'll have some more folks pop in, I'm sure. But just wanted to say welcome to all the attendees today for today's webinar regarding global elections and their impact on policy and investment opportunities. This webinar is brought to you by the CFA Society of San Francisco. If you are joining us and aren't a member of the society now, I encourage you to explore other educational and networking opportunities that are marketed on our website. For introductory purposes, my name is Dominic Bellotti. I'm a regional consultant at State Street Global Advisors, covering the San Francisco Bay Area, doing advisory fund sales. That's my day job. But additionally, I'm also the co-chair of CFA Society San Francisco's Member Programming Advisory Council. And so that's the council that's also brought this webinar to you today. But happy to say that we've got a couple of distinguished panelists with us today to discuss such a timely and consequential topic. So first, we have John Emerson from Capital Group. John is a vice chairman within the distribution business with 23 years of industry experience, all at Capital Group. He previously served as the U.S. ambassador to Germany from 2013 to 2017 and has spent time supporting multiple presidential administrations where he spearheaded and advised on bilateral trade negotiations. He also served as the Los Angeles Chief Deputy City Attorney, as a JD from the University of Chicago and a BA from Hamilton College. John, thanks so much for joining us.
Thanks so much, Dominic.
Absolutely. We're also joined by Elliot Hentov, who's the current head of macro policy research for State Street Global Advisors. Elliot is responsible for research and thought leadership that links policy impulses to financial markets and economics, as well as serving as the company's chief geopolitical strategist. Previously, Elliot was part of S&P's ratings group as a lead analyst of sovereign and government-related debt in parts of Europe. And before that, he was also a political affairs officer at the United Nations. He holds a PhD from Princeton, as well as a master's in international affairs from Georgetown. Elliot, thank you as well for joining us today. Well, let's go ahead and get started. I know that the audience is eager to hear what you both have to say. For our audience, the format is going to be about 35 minutes of a moderated session, and then we'll try to leave about 10 minutes for Q&A for you all at the end, and perhaps weave that in throughout. You'll all be muted, so make sure you submit questions to the Q&A chat function as well. But with that all said, let's go ahead and dive into the first question. So let's start up until this point so far this year. So we've had elections in a multitude of countries thus far. In Great Britain, Keir Starmer was elected prime minister in the first Labour Party control in years. We had a French legislative election that rattled the establishment a little bit, and then he had a comeback from the incumbent party, and consequential elections in both Mexico and India as well. But my question today for our two panelists is, what have we learned from the elections thus far this year outside of the United States? What kind of themes have we seen, sentiments, and then what have those trends been? John, why don't we start with you?
Well, first of all, thanks for having me. And it's great to be with Elliot, who I just learned was born and raised in Germany. So in a place that we like to visit a lot. So it's anyway, good to be with all of you. I guess a couple of things, takeaways from this year of the election palooza. One is there is very much, well, just to cut to the chase, people are angry out there. There's an anti-incumbency sentiment that we obviously didn't see in Russia, but we saw pretty much everywhere else. Even with Modi being elected, it was by a much smaller, re-elected, a much smaller margin than people anticipated. Yes, the center held in the EU elections, but by a much smaller amount. We clearly see the rise of populist, right-wing populism in particular, but populist parties in Europe. In Germany, in recent state elections in Germany, you have not only AfD, the anti-Euro, in some instances, very much xenophobic party that was created, I guess, right before we had the massive immigration surge in Germany in 2015, but really got its, that was kind of rocket fuel for AFD, has done very well in these state elections. And another party, a brand new party founded by a woman named Sarah Wagenknecht, who was with Die Linke, the far left party, and she's kind of transformed this into a far left anti-immigrant party. That did very, very well, surprisingly, a brand new party in Germany. And of course, we saw what happened in France was a big surprise. You mentioned the total throwing out of the government after many, many years of Tory rule in the UK. So anti-incumbency, anger about the direction that things are going, and two issues in particular that seem to be motivating people: immigration on the one hand, and on the other hand, frustration over inflation, and with rising costs. And I mean, we have that in our country, but in fact, in much of the developed world, they've not been able to get as much control over inflation as we have here at home. So those, I think, are the big trends that we're seeing overseas. And the question is, how much will they come to play here in our election?
Absolutely. Elliot, would you like to jump in on the same question to you as well?
Yeah, maybe I'll complement John's political analysis by saying, well, how have markets taken these elections thus far? If you take the theory, John just mentioned there's a strong anti-incumbency trend. When incumbents lose, it's typically a reflection that there's some underlying macro weakness. That's, usually a correlation. That translates into higher volatility, particularly in bond markets in the respective countries where you do get a regime flip, and mainly because it reflects that the macro cycle is at an inflection point. People, as John pointed out, people are upset, they're angry. They're not angry, they're clearly angry because economic conditions are also quite hardening. And look what we got. The French elections in particular led to quite a bond shock. You got basically more than a doubling of the spread on French sovereign bonds over German ones. And we've been cautioning our clients that will not revert to normal. We're not going back to the France of pre-June 2024, when markets were relatively calm about the French fiscal position. And it's kind of echoing John's point, because the anger and the problems aren't going away. The politics have not improved. You had an election somewhat inconclusive, so the problems are still there. So that stress in the system will remain there, and basically that risk premium that has to be applied. Now that's France, where I think everybody's kind of clear on what's going on. But the real question is what happens in Europe is not only about France, but what happens with Germany next year. That was the election that did not take place this year, and it's kind of the question mark. I think I'd love to throw the question back to John as former ambassador there, somebody who spends a lot of time in Germany. How worried should we be? Markets want action from Berlin, and what they keep on getting is inaction. Could that change next year?
Well, I think one of the challenges that the government has in Berlin is, for the first time, I think, in German history since the Second World War, there's a three-party governing coalition. And the coalition is the Social Democrats, who have very much of a left-wing wing to them, but for the most part have often been the governing partner of the Christian Democratic Union, which was Merkel's party. In 3 out of the 4 terms that she served, they were her, partner, her coalition partner. But you've got the, Schultz, who's the chancellor from that party, and then trying to manage, on the other hand, the liberals, the Free Democrats, who are very much like a libertarian party, as we would think of here in the United States. Less government action, but also very concerned about not overspending and maintaining honor to the debt ceiling that Germany has. And then you have the Greens on the other hand, and there are a whole lot of tensions and differences between those two parties. So you got Schultz in the middle trying to move the government forward on policies where, in some instances, there are irreconcilable differences between his coalition partners. So that's been kind of hard. And I would say that in all likelihood, you're going to see a return of the CDU-CSU alliance, the Christian Democrats and their sister party in Bavaria, led currently by a fellow named Friedrich Merz, who I actually spent a lot of time with in Germany as the two of us were stumping the country in promotion of TTIP, a trade agreement that we were trying to negotiate between the EU and the United States. And sort of Merz's appeal is much more sort of a return to the center. Now, the question he has and the challenge he has is, can his party do well enough so that he can actually build a coalition with one other party and not two, which is a much more manageable situation. And the fear is that at AFD, if it continues on its current pace, might actually come in second place of the other parties. But that'll be the thing to keep an eye on. My guess would be that it's moving towards not the extreme right populist, but a more conservative take on where the Christian Democrats have traditionally been, at least during the Merkel years, that we'll see next year. And then the open question being, who's the coalition partner and what implications does that have?
That's Dominic, sorry if I'm jumping back in, but that's actually not a great setup for markets, because that means you do not get kind of the big reforms, structural reforms that we want to see from Germany at a national level, at a European level. We don't get fiscal impetus to support those reforms, because you need a very strong, cohesive government. There's one thing I want to flag for everybody on this webinar, because you may have missed it. John mentioned it because it's an obscure thing, but there's the new far left anti-immigrant party in Germany. Pay attention to this, because that is a laboratory experiment. If you can combine kind of far left economic platform with an anti-immigrant right-wing sentiment, it's a very toxic cocktail. It's probably the worst cocktail from a market's perspective we could imagine. It hasn't succeeded anywhere else in any other democracy. But if it succeeds in Germany, it could probably take off as a model elsewhere. And that would be obviously quite a negative development.
That's a really good point. And the other thing I would mention to your point about structural reforms, just having spent 3 weeks in Europe, kind of talking to groups like this, there's a great deal of respect for the Draghi report that just came out a couple of weeks ago, and an equal amount of concern that none of its proposals are going to get implemented.
Well, really great context, specifically on the European side too, and everything that's happened thus far this year. And there's going to be a watchful eye, especially from that report coming out, and seeing if any of those proposals might find their way through into actual policy. Before we go to the States specifically, I know they didn't have an election in China, but I still think it's something that maybe we should cover for 5 minutes or so before we jump to the U.S. elections. But there's a lot happening in China in terms of policy and the turn on policy too, especially with the amount of investment outflow from that country, as well as the overextended property market that they have too. So, Elliot, why don't we start with you this time? What's your take on Chinese policy on an economic side and geopolitical side too?
I think, Dominic, a couple of weeks ago when we set this up, I said, well, we should leave some space for China, even though they don't have elections. And just in the last 48 hours, we had huge news in terms of markets responding to a variety of policy initiatives. On the one hand, obviously, you had a variety of monetary policy easing, variety of liquidity measures that are supposed to kind of boost the economy. But the real big news is that it looks like there was like an election behind the scenes somewhere, because they're talking about a big shift and finally bringing out the bazooka, talking about kind of a little bit like TARP style stimulus into the Chinese market to kind of do away with the negative effect from the weak property sector, and to kind of get the economy genuinely boosting some type of form of domestic demand to offset other things. But it hasn't happened yet. It's more like we're in the rumor stage. There's been news, they've kind of dropped it. And I think, ironically, we're talking about China, but they're not going to do anything until the election here takes place. And so they're waiting for the election here, because the election here will determine what policy they can actually allow themselves to pursue, given that, in Trump's case, there'd be tariffs and so forth. But there, I think it's really critical, because obviously if China does have a big pickup in demand, that will translate to commodity demand. It will translate to tailwinds for Europe. Actually, it would be one of the best things that could happen to Europe, actually, is that China recovers, and also other emerging markets.
John, anything to add on your front before we pivot to the U.S.?
Well, no, I would agree with all that, and in particular, it's interesting just to I mean, kind of show a little bit of leg on the political side of things. We've had a couple of administrations now where we've been putting a lot of pressure on Europe to disengage, not to decouple, but the phrase now, the buzzword is de-risk from China. And obviously Huawei back during the Trump era was a big point of contention. And I actually think that geopolitically, there is a positive to Europe's continued engagement with China. And it is this: the more the West completely moves towards decoupling with China, the more we reduce the cost to China of any payback or negative response they might get as a result of bad behavior in other spheres. So if you get China to a point where sanctions really don't matter, or where Europe cutting off FDI, foreign direct investment, doesn't really matter because they've reduced it so much in the interim, then you actually have less leverage on China. They have nothing to lose by just saying, well, heck, we'll just go ahead and move on Taiwan, or we'll move on that those disputed islands in the South China Sea near the Philippines. I mean, that, to me, it's something that we need to think hard about. And I think so far it's been positive that Europe has had at least a somewhat restrained but still pretty deep involvement with China. That being said, a lot of the European CEOs that I talk to, particularly in the auto companies that have a big exposure there, I make clear, don't get so dependent on China for your profitability that you're the way Germany was dependent on Russia for energy. And they're aware of that, but I'm not so sure they're doing a whole lot about that right now.
Yeah,
Absolutely.
I would just add on there that if you look at the data, I think there's little worry so far that the decoupling is actually that substantial. You've obviously had a decline in U.S.-Chinese trade over the last 5 years. But in aggregate, China G7, China trade with U.S. and its allies, it has actually risen, and it continues to rise. And it's a huge macroeconomic problem, but it's also a geopolitical problem at the same time. But to your point, the leverage still exists. Particularly because China's domestic economy is so weak, it's the reliance on foreign demand and exports has been greater. And so in some ways, the leverage may actually have surprisingly risen in the last few years. But that may not stay like that forever.
And we'll make sure to circle back a little bit. We have another question later in the stack regarding the upcoming U.S. election, but how that might also affect our bilateral agreements or trade with countries around the world. And obviously China would get mixed up. But that being said, let's pivot to the U.S. I know we obviously have a huge decision barreling down on us on November 5th here in the States. But I'm curious what you guys think in terms of how do we equate the sentiment that we're seeing overseas to what is happening here in the States? Like, do we see similar themes bubbling up? It sounds like, John, your opening salvo regarding what's going on in Europe, for example. We may see some of those similar things in the States, but again, like, are some of those themes things that are going to manifest themselves here in the United States as well when the electorate is looking to vote and what they care about? And then how are the candidates positioning themselves based off of policy, based off of some of those themes too? So John, why don't we start with you this time?
Well, the answer to that is certainly yes. I mean, when you have right track, wrong track numbers that pollsters love to ask about, something like, high 60s, low 70% in some polls saying the country's on the wrong track. So that suggests the anti-incumbency feel and bias. You look at immigration, which is fueling a lot of the frustration, certainly in some of the European countries, and that obviously is a tier one issue here in this presidential campaign. It's been a feature of Donald Trump's candidacies from the moment he rode down that escalator back in 2015, and you look at concern with inflation. Again, people, economists look at our number. In fact, when I'm in Europe, people go, we're jealous. We wish we had your economy. Why are people so upset with it? Well, it's because of the kitchen table stuff. They can they see the higher price of food. They see the higher price of housing. Sometimes it impacts their decision. They can't afford to buy a house now with interest rates, et cetera. And so that adds to the frustration. So I think we'll see all of those. But there's a curious thing that happened in our election, which is the third of three black swan events we had happen in about a month and a half. First being the Biden debate performance, second being Trump being shot, and then the third being, of course, Biden dropping out, endorsing Harris and her consolidating the party within 48 hours for her support. With this whole anti-incumbency frustration was perfectly teed up for Donald Trump and the Republicans coming into this. And now with the switch and Kamala Harris skillfully changing the debate away from strong versus weak to future versus past, now Trump's the old guy. And the way her campaign is progressing is almost trying to cast him as the incumbent. Her turn the page thing very much. Now we'll see if that works, but it's an interesting way to deal with and maybe confront and maybe overcome these trends that we've seen elsewhere in elections around the world.
It's interesting. So we've tried to quantify what John has just said. Can you measure, using macro indicators, the level of anti-incumbency sentiment? And we also have a media analysis tool. And it turns out in the US, surprisingly, it's less anti-incumbent than in Europe and in other countries. But it's still nonetheless kind of above the 50% line. It's still an unfavorable backdrop for an incumbent re-election campaign. And so the real question, really, I wonder myself, and we haven't figured out a way to measure it, has Kamala been successful in pulling off the trick of pretending to not be part of the incumbency and actually is running as a new candidate? If yes, then most of our indicators would mildly favor her. If she has the incumbency brand attached, she would narrowly lose on the dashboard that we try to create. But it's really, we've never had this case where the rotation of the candidates under these circumstances and this kind of last minute reinvention. She's not even running on the administration's record. So is she?
So what's your data show you in that at this point?
Well, so the weak point, most of the macro data is pretty good. The weak point, and that's, as you alluded, is because of inflation. The one where it's usually a big one is real disposable income growth is below the threshold where incumbents typically get reelected, and that obviously isn't it because of the after effects of inflation. If she's not the incumbent, then that doesn't tag her, and then you basically have all the other features which have to do with age and turnout and volunteer enrollment, donation flows. Though on those quantitative metrics, she has a mild, really a mild lead on the other side.
Well, what's interesting is the way the campaign is progressing is she seems to be, Biden was just obsessed with convincing people he'd done such a great job on the economy and, kept talking about the numbers and this and that, and maybe was a little too slow at recognizing, maybe was fundamentally a little too slow at recognizing that people were still hurting out there in part because of the cost of living. And she doesn't seem to be spending much time at all talking about all the job creation, this and that, unless it comes in the context of answering are you better off than you were 4 years ago question, when the contrast is to 2020 when things weren't so good. But it's much more about lining out what she wants to do, in the future, and almost and for sure acknowledging that there is pain out there that has to be addressed. So it's kind of interesting, and I think you're right. That's going to be that's one of the known unknowns. We know that the economy is going to play a role in election. What's unknown is what are the indicators that come up in the next 6 weeks or 5 weeks that that will have a significant impact on that. I mean, if all of a sudden it looks like inflation is coming back, I mean, you have this external validation that maybe inflation is getting under control with the Fed cutting for, by 0.5%. And what happens if that next month the indicators are that inflation is much higher, and so what happens if all of a sudden unemployment jumps? That under those circumstances, if I'm the Trump campaign, I'm jumping all over those things. But that's what we know it's going to be an issue, but we're really not sure on how it's going to play out. But I think she's positioned herself as well as she possibly can on that issue, being the fact that it is the Biden-Harris administration.
John, and I'm just going to jump in here because I think this is a perfect segue too, because we talked about how they're positioned, how voters are viewing them. Now I think we should get maybe into policy a little more deeply too, specific economic policy and how it might affect markets. I'm sure our audience is probably interested, seeing as how it's a CFA group, how this might affect investment portfolios and opportunities. And we'll take it in bite-sized chunks too, because we want to make sure we cover everything. But how should we be thinking about this election in the context of debt and taxes, right? With 2018 Tax Cuts and Jobs Act sunsetting next year, dollar strength, and then you also mentioned interest rates as well. So, John, we can start with you. And
okay, well, I just want to say there's one other thing that we have to pay attention to on this, answering this question, and that's what happens in Congress. Because if you have a red wave or a blue wave, and I think it's next to impossible with the blue wave, because for the Democrats to hold the Senate with all those vulnerable seats they're defending is going to be a tall order. But it's possible you have a red wave with very narrow margin in both the Senate and the House. But in all likelihood, you're going to have a split Congress. And so that means that what we're about to talk about in terms of what the candidates' proposals are is going to be moderated somewhat by the need to negotiate and compromise. The one thing we know for sure is that 2025 is going to be a year when Washington is going to be completely obsessed with debt and deficit and taxes. Why? Because in the spring, the debt ceiling comes up for being increased. And in October, the Trump tax cuts from 2017 expire. And if they're not renewed, we revert back to the tax policy towards the end of the Obama administration. And if they are renewed, we've got a $4 trillion 10-year spend that somehow is going to need to be paid for. So we can break it down. I want to let Elliot talk, but just to the big picture is, you're right. 2025 is going to be the year for a lot of focus on debt, deficit, and taxation.
Yeah, I couldn't agree more. I think it's also the most impactful transmission mechanism to all parts of capital markets, because U.S. bond market is going to respond very forcefully to any of these extreme outcomes, and even within the narrower range of outcomes, there'll be some movement. So I think the fiscal story, so it's really what markets need to know is, will there be a split Congress or not? I agree with John on our metrics. There's like a 3/4 chance the House goes Democratic. That's pretty high. That's higher than what betting markets have pegged it for. In that scenario, then the fiscal story recedes a little bit. We'll have to wait till the spring and the autumn to see where the budget was. In the event that Trump wins, even with a split Congress, though, he has obviously a policy agenda that is market meaningful. Everybody on this call knows very well what that is. But I think what's meaningful is last Friday I had lunch with a key member of his economic advisory team. And I think the message I want to channel here is was all basically financial market professionals at the lunch, is how central tariffs are to his policy agenda and how rapidly he will move on the tariff agenda, disregarding any of the objections that markets may have or some of his constituencies. So if he does get elected, I would take the tariff agenda very seriously. I would even pencil it in to really be taking place over the first few months of the administration. And that has obviously a big impact on currencies, that has a big impact also on inflation in the US and elsewhere. And so that's obviously going to be the biggest dial. There's other parts of the policy agenda that matter too. And I don't know, Dominic, if we still have time to get into those.
I completely agree on the tariff situation. I mean, you talk to Lighthizer, who was his trade rep, will either be his trade rep or his top economic advisor. And he is, just adamant that this is the absolute right way to go. And, it allows Trump to say, hey, I can pay for the extension of the tax cuts and other things because I'm going to be raising all this money for tariffs. And of course, as we know, tariffs just get passed on to the consumer, number one. And number two, I read one thing, and Elliot can correct me if I'm wrong, but this 10% across the board tariff that's being proposed on everything that comes into the United States. By the way, I'm not sure how you deal with supply chains on that, or how you deal with the BMWs that are actually manufactured in the United States, but with German auto parts. But in any event, that would generate at best between 80 and $100 billion a year of revenue. When you're talking about a 10-year, run on that and a 10-year $4 trillion spread on the tax cuts, that certainly creates problems for debt and deficit. And if tariffs work the way they're supposed to, what'll happen is people are going to start buying less and less of the high cost items. And so you got less that you're taxing and you got less tariff revenues as well. But I think one thing that I think we need to pay attention to is that Trump seems to be focusing on tariffs as a be-all and end-all answer to how you pay for things. And I also must say I was struck by the first time in my lifetime of paying attention to this stuff that the Republican National Convention platform was silent as to debt and deficit, which I thought was pretty significant.
Yeah, you hit the nail on the head. We actually just had a question come in regarding how neither candidate seems to address the deficit. Conventional wisdom would say that, if the Republicans sweep, you'll probably have an extension of the Trump tax cuts and then perhaps even a lowering of the corporate tax rate. And, on the Democratic side, you typically have more spending. Even if taxes go up, typically spending goes up congruent with that too. So, do you see either candidate or administration trying to tackle deficits moving forward? They haven't necessarily talked about it, but curious, some comments there too.
Well, I was struck that Harris did mention it in her acceptance speech, because you don't usually hear that in Democratic acceptance speech. And she does talk about, she's less about tax cuts, although there'd be some, and more about stimulus, whether it's that, maybe it's in the form of a tax cut, but the tax credit that for new business owners or for people trying to buy their home, or the child, per child tax credit for people under a certain income level, that would basically renew what the Biden-Harris administration did in the first year during COVID of their administration. So she talks about it, and at least her taxing and spending, I haven't seen the numbers to see if it's a dollar for dollar offset, but at least with the tax increases, there is a pay for element to it that is probably more significant than some of the tariffs that Trump's talking about adding. I would add one other thing that rarely comes up in these conversations, but I think is hugely significant from an inflationary standpoint and a disruption standpoint. And that is this, which I also believe is very much on track because it's such a part of Trump's brand, but this idea of rounding up and deporting as many as 10, 11 million people who are living in this country illegally. The fact is, most of those people work. They're doing jobs. Many of them are paying taxes. You just forget about the human toll and the disruption to our communities. You've got people that are married to, people who are here illegally, but they're citizens. I mean, all that kind of thing, incredibly disruptive. But setting that aside, just look at the pure economics. First of all, if all of a sudden you're, rounding people up and deporting them, what does that do to industries that are heavily immigrant dependent? What does that do to small businesses, which many of which are started by immigrants, and certainly many small businesses are immigrant dependent for their employees? And let's say those people all leave. How much money are you going to have to spend, thinking inflation, to hire other people to do those jobs in a tight labor market? So I think you have to look at the immigration policy as part and parcel of inflation, and certainly as that relates to debt and deficit.
Yeah, so Dominic, John touched on both kind of the inflation part of the agenda and a little bit of the fiscal. I'll try to translate it a little bit into kind of what John said. So when you think of the speed of which some of this transmits to actual inflation data, the trade part is, it's not instant, but it is relatively quick because, inauguration January, tariffs get imposed February, they started to get collected in March. You already have changes in inventories that front run that, and then you have kind of behavioral consumer behavior changes, purchaser behavior changes. And so basically within months, you start to see the effects of the tariffs trickle through. So I would say even by mid-year, you would start to see that show up in inflation data. It's not huge, but it's noticeable, it's perceptive. The migration story is much harder to capture. It's certainly inflationary. And we're even wondering, even if it doesn't come to deportations, just the signaling effect alone could basically deter labor market participation or make it harder for labor market participation of some of the migrations, and particularly the new additional supply growth. Well, I shouldn't call it so unempathetically, but the growth in the workforce that would trickle through, but it takes longer. That's something that would start to show up 12, 15 months later. But they do all matter. And most importantly, financial markets will take what John says today or on November 5th and already forecast into the future and basically discount accordingly. And that can have a little bit of a disorderly effect on bond markets and those sectors that are particularly hit or reliant on that. On the fiscal side, I just want to say the Democratic sweep is the one story that on paper actually is fiscally an improvement to what we have, because there's tax increases as part of it. That's not great for stocks and equities and other risk assets, but that is good for the deficit. But it's also the least likely scenario. All the other scenarios, we have basically best case a continued elevated deficit that's not sustainable, or one that actually widens even further and could become more of an acute crisis.
Yeah, it'll be interesting to see. I mean, for those CFAs that are on the line, we all know that population growth is one of the inputs into GDP growth. So if we have that go into the negative, at least from an immigration standpoint, it'll be interesting to see how that affects growth in our country moving forward. I know we only have 5 minutes left, and then we have a hard stop. So I'll quickly ask this question, and then maybe get a 1 to 2 minute answer from each of you. Elliot, I'll start with you on this, just because I know we've done a lot of research in this space, specific to sectors of the economy. Obviously, we even have products specifically at State Street focusing on sectors. But what sectors in our economy would be the winners and losers based off of certain administrations? Obviously, depending on what type of policy could even get passed through Congress, for example. But high level, if you were making investment plays in specific sectors based off of investment from the government, who would be winners and losers?
Well, to start with, and we're back to where this webinar started with the anti-incumbency, the three of us cannot be fooled by Kamala's Houdini trick. We know that she actually represents policy continuity. So from a if you wanted to say, well, who would benefit? Well, it's all in the price today, because that's obviously the status quo in terms of the kind of largely the regulatory and fiscal backdrop. So really, it's really just about who would benefit, who would be winners and losers in a Trump administration. And again, I'm assuming a split Congress, and we can then think, well, who benefits, gets hit by trade, migration, by energy deregulation, by forcing, sowing doubts about the NATO alliance, or pushing up demand for defense expenditures, and what other sectors are also regulation sensitive. And then you can kind of map it out. And in a nutshell, it's obviously very regulation intensive sectors tend to benefit more. That's financials like ourselves. So like we are not, just to be very clear, we're not objective bystanders on this. As an industry, energy would benefit from from an equity perspective, earnings, because there'd be lower compliance costs, lower disclosure costs, and other favorable treatment. And then, of course, industrials, parts of the reinvestment in U.S. industry and the boost for U.S. defense exports would rise too. And those are clear winners. The question mark, the big question mark for all of us is any part of big tech vulnerable in a Trump administration? Is there revenge against Meta and Zuckerberg, or does he just let kind of the beginnings of tighter tech regulation unfold? And does that curtail the big bull market that we've had in big tech?
That's a great question, and I agree with everything you said. And I would just add to that, what is the Trump antitrust policy going to be? You got, the Google case, you've got the Apple case proceeding. What are the implications for that? Look, Trump's a populist, and populist rhetoric and policy often goes after the big guy, and so it'll be interesting to see how that one progresses as well. And speaking of tech,
absolutely, and you can already see some of these folks already positioning themselves just in case you have a different administration come in. I think Zuckerberg has changed his tune a little bit in the last handful of months, as we've seen. But I know we're up against the gun here, so I'll go ahead and close this out. First of all, Elliot, John, really appreciate you both taking the time today. I speak for the society when I say we appreciate you both. Thanks for all the education too on what is a complex and critical topic for us. It was an insightful conversation. I hope everyone has some actionable takeaways too from what you both discussed. And then thanks to the audience too for the attendance and the question that came in. But otherwise, please continue to join us for future programming as we look to provide similarly impactful sessions to our membership. But other than that, have a great rest of the day. And again, Elliot and John, thank you so much.
Take care. Thank you.